Hello, good morning. You're tuned into Power Breakfast in the Mumbai News Center. I'm Anisha Jain and with me is Manglam Malu. Well, Manglam, good morning. Now, yesterday we did have the global tailwinds, but we ended 60 points off the day's high when it comes to the Nifty.
Right.
Today as well, the global cues are supportive, and we got this domestic advanced GDP number for FY19, a tad bit sobering, but nonetheless, 7.2% is the rate that we got. We're facing a bit of resistance around that 10,850 mark. Let's see whether we break out of that today or not.
Absolutely. You know, we're placed at a precipice as far as our markets are concerned. We're at the 200 and the 20-day moving average. At the lower end, you have the 10,650 mark, which is the 50-day moving average, which is considered as a strong support. And at the higher end, of course, the 10,850 mark, which is the 100-day moving average. But all that and more, first up, all the top stories that we're tracking this morning. Wall Street ends higher as US-China trade talks resume. Gains in Amazon and Netflix fueled a second straight session of up move for the US markets. Asia, too, starts the day on a positive note.
The economy is likely to grow at 7.2% in this financial year, shows the advance estimate by the CSO. This is below the RBI estimate of 7.4%, puts the overall growth rate under the 5 years of Modi government at 7.3%.
Bandhan Bank announces the acquisition of mortgage lender Group Finance through a share swap deal. The swap ratio shows Group Finance shares have been valued at an 8% discount to yesterday's closing price.
NCLT completes hearing on the maintainability of Ruia's offer for Essar Steel and gives respondents a week's time to make their submissions. The tribunal is expected to pass an order on the offer before 31st of Jan.
Well, let's take a look at the Asian markets. They're mostly higher ahead of the second day of the US-China trade talks, which will kick off later in the day. A spokesperson from China's foreign ministry said that Beijing is willing to resolve its trade disputes with Washington on an equal footing, and that takes the Nikkei higher. Slight weakening on the yen as well. 108.5 is what we see out there. 0.6% higher for the Nikkei. Remember, Wall Street had a very volatile session. Just take a look at the Korean index, though. The Korean index is underperforming the other Asian peers, and that's primarily on account of Samsung, which is lower in trade. For all you Samsung fans and Apple fans, you all thought Apple is the only one not doing well. Well, no. It's actually Samsung, which is also not doing too well. So the Korean index should come up for you. Their fourth quarter profits were below estimates, and as was the guidance, which is why the Korean index is in the red as we speak. The Straits as well as the Taiwanese indices absolutely fat, and the SGX Nifty, that one should come up for you, sitting with a cut of about 5 to 7 points when I checked last, and that is where again it is about 13 points on the red side. Nothing too much to really worry as far as the open is concerned.
Okay, so the Asian markets are a tad bit mixed, but as you mentioned, the US Commerce Secretary Wilbur Ross said that the two economic superpowers were likely to reach a good settlement over immediate trade issues, although he did warn that longer-term problems would prove more difficult to really negotiate.
There's a very good chance that we will get a reasonable settlement that China can live with, that we can live with, and that addresses all of the key issues. And to me, those are immediate trade. That's probably the easiest one to solve. More soybeans, more LNG, things like that. Second, structural reforms, much harder. That's about intellectual property rights. The third is the hardest, which is an agreement is fine, but the history here has not been so good on compliance.
All right, and on that note, let's also hear out what market men are making of the trade negotiations that are currently underway.
It's interesting, when the S&P was down 10% a month or so ago, there was certainly less incentive for politicians to move forward. But now that, we briefly went down 20% as of about a week or so ago, it's become a little bit more urgent. Of course, the Chinese market has been down far more than that for a while. So my expectation is that there is enough motivation to get something done. I don't think that's going to be the end of the story, though. I do think that this is a very long-term, containment strategy on the part of the U.S. So I think it'll be a win, but I think the longer-term battle will go on for quite a while longer than that.
Okay, let's move on and take a look at how the U.S. markets closed, because the U.S. stocks closed higher, building on Friday's powerful rally as investors watch for further signs of easing tension in the protracted trade dispute between U.S. and China. Now, the Dow Jones climbed around 100 points, the S&P 500 gained around 0.7%, and this was led by the gains that we saw in the consumer discretionary space. The Nasdaq Composite as well advanced 1.25%, and that was boosted by solid gains seen in stocks like Amazon as well as Netflix. CNBC's Aditi Roy gets us a wrap of all the action on Wall Street.
U.S. stocks finishing higher, though off their best levels of the day. The Dow adding 98, the S&P up 17, and the Nasdaq tacking on 84. Eli Lilly buying Loxo Oncology for about $8 billion today. The focus of the deal is on a portfolio of targeted medicines to treat cancers. Shares of Loxo up better than 66% on the news. It's a second major pharma deal in the past week, with Bristol Myers announcing it would buy Celgene for $74 billion on Thursday. Meantime, more and more Americans think it's a bad time to buy a home, as fewer potential buyers can afford what's on the market. The share of Americans who think it's a good time to buy a house has dropped sharply, according to a December survey for mortgage giant Fannie Mae. Higher mortgage rates and increased home prices are likely to blame. And Disneyland is raising admission prices ahead of the opening of its Star Wars-themed expansion, with the cheapest daily ticket costing more than $100. The prices took effect Sunday. Annual passes and parking saw increases of up to 25%. It's the second price hike in as many years at the park. That's the action from the U.S. market. Back to you in Mumbai.
So that's what took place in the US yesterday, but let's move on to a CNBC exclusive. Former five-time Fed Chairman Alan Greenspan, he remains pessimistic on the general economic outlook. CNBC's Sarah Eisen caught up with Greenspan and began by asking him if the Fed should be paying closer attention to the message in the markets right now. Regarding growth and inflation, let's listen in to what he had to say.
I don't think they're watching the proper statistics. As far as I'm concerned, monetary policy is interesting but not relevant to what the longer term, or even intermediate outlook is going to be. As I've argued for quite a while, I think that the issue of entitlements has been, which is just rising with the population and aging of the population. But the data show unequivocally that is crowding out capital investment dollar for dollar. And that's been true since 1965. And that says basically that productivity growth is going to be less than we expect, and as a result of that, a lower GDP.
You think the Fed should be paying more attention to that? Should they have not raised interest rates in December?
No, I think the Fed is doing fine. I'm just saying that fiscal policy is a critical issue. Monetary policy is not at this stage. At some points, it's critical, but this is not one of them.
A few weeks ago, you made some headlines warning that investors should run for cover. Is that the risk you were looking at, the slowdown in productivity and the rise of entitlement spending?
Well, that's pretty much the same story as I'm now indicating. But I remember the run for cover issue. I think I was trying to get out of the rain.
What about the markets right now? How do they look to you? I mean, we're what, 14% off the highs in the S&P 500? It's been a turbulent few months.
Well, it's basically what we do is we take price-earnings ratios and turn them upside down so you get earnings-price relationships, and we can attribute that the sum, the total of earnings price are directly related to the current data on the rate of return on a lot of different assets, but mainly it's real long-term interest rates which drive the numbers.
Okay, so sobering commentary coming in from Alan Greenspan, and actually sobering commentary coming from former Treasury Secretary Larry Summers as well, because he says there is 50% chance of a US recession within 2 years. Here is more from the Harvard University professor on which conditions in the market could really lead to recession.
There are no certainties, but this recovery has been going for a long time. Financial market conditions, as measured in the stock market, as measured in credit spreads, as measured in inversions in part of the yield curve, are flashing very cautionary signs. There's lots of signs of economic difficulty in China. Some of the more forward-looking economic indicators are suggesting a cause for concern. All of that suggests to me that the risks are now more on the downside than on the upside. The data from China is substantially managed, and that means it's hard to know what figures will be ultimately reported, and that also means that even smaller signs of deterioration in the reported statistics are a greater cause for concern than they would be in the United States.
All right, and in Europe, the markets closed lower amid concerns over economic growth, Brexit, and the US government shutdown. Also, there was, the data that came in from Germany, the revised data that suggested that manufacturing in November was actually lower than what was previously reported. And add to that, the next 2 weeks likely to be volatile as Brexit talks continue, and the sterling was about at a 1-week high. So just keep an eye out on all the European indices. They opened mildly in the green, and from then on, they ended closer to the lower end of yesterday's trading session. Similar with the cuts that we saw across the peripheral indices as well, and the Russian index too was mildly in the red.
Okay, so that was about the European markets, but back home, the big story is that the government expects the Indian economy to grow at 7.2% in the current financial year, and this compares to the 6.7% in FY18. However, the CSO's advanced estimate figure is lower than the RBI's estimate of 7.4%. The CSO's office puts the overall growth rate under the 5 years of the Modi government at 7.3%. Lata Venkatesh is here to break down those details for us. Lata, tell us, does the number look a bit sobering?
Yes, it indeed is, and it is sobering not only because it's lower than what the Reserve Bank had calculated at 7.4%. The 7.2 is made up of a 7.6% first half growth, which we already know that was 7.6 because the year ago base was very low. If you have 7.6 for the first half, to get a full year of 7.2, you have to be reporting 6.8% on an average for third and fourth quarter. Chances are it would be maybe closer to 7% in the third quarter and closer to 6.5% in the fourth quarter. So that is the sobering fact, that third and fourth quarters have genuinely slowed. We have not even reached the 7% mark. Let's look at the composition. First, the heartening ones. The heartening ones are the gross fixed capital formation. That has been forecast at 12.2%, a double-digit growth compared to 7.6. At least that holds some promise for the year to come if capital formation itself is increasing. But the good news is just that. And the last line, as you can see, exports up 12.1% compared to 5.6. That's good going. But the sobering number are the consumption numbers. Private consumption already last year at 6.6 was nothing to write home about, is falling to 6.4%. And government expenditure also falling to 9.2 from 10. Quite clearly, government capex, etc., are going to be cut. That's what is getting factored in over here because the tax returns have been bad. This is looking at GDP from the expenditure side. Let's look at it from the output side. Agriculture has not done too badly at 3.8%, but construction and manufacturing certainly something to boast in terms of Make in India. 8.9% in construction, good compared to 5.7%, and likewise manufacturing at 8.3%. You cannot ignore, of course, both of them have done well because of a terrible base effect, but nevertheless, it's a good number to go with. The bad performance is in the services, and that's sad because 60% of India is employed in the services sector, and there, as you can see, in every metric, it's done poorly. 8% of last year in trade, hotels, transport and communication is now slowed to 6.9%. Finance is more or less the same at 6.8%. The last quarter, the bank deposits and, more importantly, advances growth has picked up, and that's why 6.8%. Public administration, usually health, education, stuff like that. Also lower because last year, perhaps the finance, the pay commission numbers had pushed up the public administration. That has also sobered now by about 100 basis points. So overall, the sad part is agriculture at 3.8. I just wanted to add this point. Even if you looked at the nominal, that is, this is at constant prices, agriculture even at current prices is only grown by 3.8, indicating that there has been no increase in prices. Given that kind of an agriculture or a rural scenario, clearly consumption has not fired, and it looks like a part of this will hang over to the next year as well. Usually in times of political uncertainty, you shouldn't expect too much of capex. As well, there is a large base. The first half of this year is 7.6. That will be the base for next year. So looks like the first half of FY20 also is going to be a sobering 2 quarters.
All right, so those are sobering estimates as far as the growth numbers are concerned, and especially for the first half of FY20 as well.